it. Today is a presentation about your PeopleShare 401k plan. As I mentioned, my name is Melissa Varvarezes. I'm from BPAS. We're the record keepers for the plan. You also have on the account Kevin McDermott. He's your advisor, and he works at Casimir, and he'd be able to assist you with some investing questions if they come along. So today's presentation is fairly brief. We'll go through the basic information, why you need to save for retirement, the advantages of a 401k, the highlights, how to go about investing your 401k money, and then finally, how to enroll and access your account. Feel free as we go through things also to ask questions. You can either, if you're not on mute, you can jump in on the phone line and ask a question, or you can type it into the chat field, and I'll make sure everything gets covered by the end of today. So when it comes to retirement, most of us are pretty aware that we need to save some money and put it aside for it. Social Security, the estimated salary income is about 35 to 40% of your current salary is what would be replaced in retirement. And that's not going to be enough, quite frankly. Financial advisors and experts out there estimate that you'll need about 80 to 100% of your current income to live a similar lifestyle in retirement. So, for example, if you're making $40,000 right now, you would need $80,000 or $32,000 to $140,000 each year in retirement. So $32,000 to $40,000 in each year of retirement would give you a similar lifestyle if that's your current salary level. Some expenses do go down in retirement. You're not commuting to work anymore. You obviously don't have to buy work clothes and lunch every day and everything like that. And lots of people, when they hit retirement, tend to have their houses paid off or have fairly low mortgage balances remaining. Other expenses, however, when you hit retirement, do tend to increase, and the key one of those is healthcare expenses. Every year, Fidelity does a report on retiree healthcare expenses, and in December of 2016, they calculated that number, and they found out that the average 65-year-old couple retiring this year would need $260,000 out of pocket just for healthcare expenses. So that is in addition to Medicare premiums and any other kind of health benefits they have. Out of pocket, a couple would spend $260,000 now. So we need to start saving in our retirement plans to help accommodate for that. And then finally, the last stat there, 1 in 4 Americans will live past 90, 1 in 10 live past 95. So it's important to plan for your retirement years because you might be in retirement for about a third of your life. So we should be planning accordingly. When it comes to saving for retirement, maybe I'm a little bit biased because I work in the field, but a 401k is probably the best way to save for retirement goals. If you haven't had a 401k before, it's essentially a very glorified savings account with retirement being the key goal. So taking money out for other reasons tends to be a bit complicated and not always possible. But if you're looking to save for retirement, you can see all the advantages listed here. Won't go through all of these in detail, but just a couple key notes. Anything you contribute to the 401k plan comes directly out of your pay and goes into your 401k at BPAS. So it's an out-of-sight, out-of-mind way to save, but it's actually really disciplined because of that. Because you're paying yourself first before you even get your check, you're less likely to go spend it at the grocery store or on some other item that you may or may not need. Instead, you're putting it away for your future retirement goals. The money in the account is yours. You get to choose how to invest it, either conservative, aggressive, or any mix in between. And as it's yours, if you decide to leave PeopleShare in the future and go to another job, the account balance is portable. It goes with you to that next job or into retirement. Retirement savings can be affordable. Determining how much you need to save is something we can talk about today. But trying to figure out how much you can afford, we have calculators on our website that can assist you with this. And you can see just some sample calculations here. You have the option of doing pre-tax or Roth contributions. This slide here shows you pre-tax contributions. And in the example here, let's look at that orange price tag. This sample is saving 8% of their pay, or $62. So they see $62 go into their retirement account. But because it goes in pre-tax, they get a little bit of a tax break. So they see $62 go towards retirement, but just $52 out of their paycheck. Might not seem like a huge deal, $10 out of your paycheck difference in taxes, but over the course of a year that can add up, and over the course of time that can be a pretty significant amount. Another key benefit of your retirement plan is the idea of compounding. You put in a contribution each pay period, it generates a return, and then that return generates a return. So it kind of builds off itself. The best way to take advantage of compounding is to start saving as early as possible and to save as much as possible. You see the chart here, someone starting in their 20s with 40 years until retirement can build up quite a significant retirement account balance. If they waited just a few years, 10 years in this example, and contributed, you can see it's still a good balance, but a little bit less. So if you're young and thinking, retirement, that's forever away, what's the point of it? It's definitely worth getting involved right away. And if you are a little bit further out, you're currently in your working years and thinking, I'll never catch up, even if you look at the right-hand side, because of compounding, it really benefits you to save in that account, no matter what age you are, to take advantage of those compounding, that growth of your retirement account and those tax savings. So we'll walk through some of the plan highlights of the People Share Plan. You're eligible as long as you have 6 months of service. You can see the excluded employees listed there. Generally speaking, based upon our morning session, the excluded employees are the branch managers and temps. If you have 6 months of service or more, entry dates are quarterly as listed there, but you can enroll after that fact as well. So once you meet your 6 months of service, your first eligibility date would be listed on the quarter below. And if you miss that, you can jump in the next pay or 2 pays after that, or whatever the case may be. As this is a new plan rolling out now, we have been requested to return all enrollment materials by Friday, June 23rd, to get started with the July 1 payroll contributions. So if you're currently eligible, you're ready to join the plan, make sure you do so within the next 2 weeks to get that enrollment started. You can contribute as little or as much of your pay as you'd like, as long as you don't go over the IRS limits for the year, and they're listed there. Your contributions are by percentage, and they're whole percent only. And there is a question that popped up. So what's the deadline again for the July enrollment? Again, it's Friday, June 23rd. So you have about 2 work weeks to finish that. And thanks for asking that, and I will try to remind everybody at the end of the webinar too, as also to refresh your memory on that. So with your contributions, you can contribute in whole percentages. There's the pre-tax feature and the Roth feature. You can choose one or the other, or a combination of both, as long as you don't go over the IRS limits, and we'll talk about those differences if you're unfamiliar. Your employer has the account set up for discretionary contributions, so down the road they may decide to put in contributions to the account as well. And you can see under that it says vesting schedule 3-year cliff. A few slides ago I had mentioned that if you are currently an employee and saving in the account, and if you leave, that money goes with you to your next job or to retirement. So that's your money. Any money that you personally put in the account is always 100% yours. It's always 100% vested. Contributions coming from the employer are subject to a vesting schedule. The People Share schedule is a 3-year one. So you need to be an employee for at least 3 years to lay full claim on any contributions that People Share put into your account for you. If you are under those 3 years, the contributions will still be made, but if you leave before that, you would forfeit that portion of your account. And I'll show you that on the website too, so it makes a little more sense of how it works. We do keep track of that vesting schedule for you, and again, it's based upon when you started working for the company, not when you started saving in the 401k. So as mentioned, we talked a little bit about, I told you there's a pre-tax and a Roth 401k feature. They work differently with their tax treatment. So with a pre-tax or a traditional 401k, when you put the money in, you don't have to pay taxes on it. If you remember our orange price tag, that person was putting $62 in their account, but just seeing $52 come out of their pay. They were saving $10 every pay by doing those pre-tax contributions. Any earnings that that account makes, you put in that $62, maybe it does a 6% return, an 8% return, whatever. All of those earnings accumulate tax-free as well. You don't have to report anything on your taxes each year. It just continues to grow. With a pre-tax account, you don't pay any taxes on it until you take the money out. So when you take the withdrawals, which are typically at retirement, you're taxed at your ordinary income level. With the Roth 401k, it's almost a mirror image. With the Roth 401k, you put in the money after tax, so you get no current tax break on it. If we remember again our orange price tag, that person was putting away $62. If they decide instead of doing the pre-tax they wanted to do Roth, they'd put $62 into their 401k and see exactly $62 come out of the check. No breaks, nothing. What they put in is exactly what they see come out. The earnings also accumulate tax-free in the Roth 401k, but the difference is the distribution. When you take money out of a Roth 401k, you do not have to pay taxes on it, because when you put that money in, you pay taxes. So we'll keep picking on our example here. That person put in $62. They pay taxes when they put that money in. If that $62 grows up to be $10,000, they don't have to pay taxes when they take it out. There is a little asterisk to that. You need to have the Roth 401k open for at least 5 years, and you need to be over 59.5 years old to have all those withdrawals tax-free at withdrawal time. So keep that in mind. If you're getting close to retirement and you're thinking you might plan to retire in the next 5 years, a Roth might not be a feature for you. If you're planning to be here longer than 5 years, then take a look at the different tax situations and see what might work better in your current situation, either a pre-tax or a Roth, or you can do a combination of both. We do have a calculator at our bpas.com website that gives people a little bit of help in this and estimating what could potentially their account can do if they choose one of these methods over another. Wrapping up the plan highlights, your beneficiaries can be updated at any point in time online. So when we'll go through the enrollment steps today, if you do nothing else, make sure your beneficiaries are up to date. If you have retirement plans elsewhere, you can roll them over in this plan at any point in time as well. And then also, we give you the option, you can go green and receive all of your statements online. If you choose to receive them by mail, just note that you can still access them online in the future for your reference. So if you don't feel like filing them and you just want to look at them, you can certainly take a look, shred it, and then access it online in the future. So when it comes to saving for retirement, most people know they need to save for retirement. They have an idea of how much they can afford to do so. And then we ask them the key question, well, how are you going to invest it? You have about 20-some different mutual funds in your People Share 401k to invest in. That's usually where people get a little overwhelmed. They feel investing is too risky, it's too complicated. I'm happy to tell you today, with the way this account is set up, it's not really risky, it's not complicated. There's some different options for you if either of these are your concerns. So when it comes to risk level, some people are concerned about investing in the stock market because they're afraid they'll lose all of their money. And there is certainly some amount of risk when it comes to investing in the stock market. But the odds aren't really as bad as we would think. If you look over here on the left-hand side, you take $1 to the casino, chances are you're probably not walking out with $1 or much earnings on that. The slot machine, you put $1 in, you have a 40% chance of winning that money back. On the right-hand side of the chart, it shows you what would happen if you invested in the stock market. So if you put $1 in the stock market and held it there for 1 year, you would have a 75.3% chance that you would make a return on that investment. So another way to say that, on average, 3 out of every 4 years in the stock market tend to be positive. The longer, however, you hold that dollar in the stock market, the more likely it is you're going to get a positive return. If you hold that investment for 15 years, you have a 99.8% chance that you'll still have that dollar, and most likely significantly more after that. Another concern that people have, again, with that risk is, I'm going to lose everything in my investments. And this chart here shows you 2 different types of investments, the blue Treasury bill, which is a cash-like investment, or the red 500 index, that's a stock market investment. If you were an investor back in 2007, 8, 2009, you know the market took some big hits during that time frame. And we can see that with that 500 index. So we have here as an example a $10,000 starting balance. 2008 came along, stocks took a hit. Some of the stock investments out there lost up to 38, 40% of their value. The 500 index lost about 21% of its account value. So if you had $10,000, all of a sudden you saw your 500 index drop to about $7,900. If, however, you kept that money invested, you can see it rebounded. By 2010, that money had already gone back over the $10,000 limit. And by 2016, your account has more than doubled. Cash investment, on the other hand, tends not to lose money. We rarely see it go under $1. But as you can see with that investment, 2008, it didn't lose any money. It stayed pretty stable. But over the course of time, by 2016, there wasn't a large amount of return in that. So keep that in mind. You can certainly play it safe if you're comfortable. Hey, I'd rather have $200 than watch my account go up and down at any point in time. You have those different investment options to work with. When it comes to picking and choosing your funds, we also hear that's our other myth. Well, investing's so complicated. I don't want to do this. I don't know how to do this. And certainly understand that. People are experts in their jobs. When it comes to investing, that might not be their specialty. With your 401k at PeopleShare, there's 2 different ways you can go about your investment style. If you're confident in picking and choosing your own investments and you like picking and choosing your own investments, we have a variety of mutual funds for you to select from. If you're more passive, you don't really understand the investing, or you just don't have the time or interest to go through all the different investment options, we have some choices in the plan that might work for you as well, and they're the target date funds. We'll get into a little more detail with this with the actual investments in your plan, but when it comes to picking and choosing investments, there's different levels of risk. If you recall that other slide with the Treasury bill that hardly moved, that's a low-risk investment. It's a money market type of investment. So there's not much risk in it, but as you saw, there's not much return either. Over the course of time, it really wasn't paying a significant amount. On the right-hand side of the chart, you have some different type of stock investments. There's a larger amount of risk with those types of investments. You will see sometimes where you're going to get a negative statement, but there's more return on average with those investments as well. So if we were to tell you right now these are the funds in your account, some people know that they're going to gravitate to the left-hand side. They want that low risk. They don't care if the return is low. Other people are willing to take on more risk for that higher return. And then there's the majority of people who are like, well, I kind of think both of those ideas have some merit to them. There's some features over here that I like. There's some features over on the other side that I like. And they mix and match their accounts. So they might have some low-risk investments like money markets and short-term bonds, and they might have some higher-risk investments like small cap and international stock investments. And that concept is called asset allocation, and it's very common. And simply, it's just spreading your investments between stock, bond, and cash investments in your plan. The reason you'd want to do this is it helps minimize the risk. If your account's 100% in stock and the stock market has a bad day, there's 100% of your account that's going to have a bad day. If, however, part of your account's in stock and part's in bonds and the stock market has a bad day, maybe the bond market didn't do as poorly, and it kind of helps balance it out. Everybody's asset allocation is a personalized mix. I'll give you a link at the end where you can do a questionnaire to see what your allocation is. So you can pick and choose based upon how soon you plan to use the money, what the money's for. Is it for actual needs during retirement, or is it more a little spending money? It may also depend on how you treat those investments. So going to the investment options, this chart here kind of follows the path of the one we had seen a few slides ago, going from the most conservative investment options to the more aggressive investment options. So you have your conservative money market option, low risk, low return. You have a couple different bond funds that you can choose from and diversify with. So if you decide to set up your asset allocation of, I'm going to put X% in stock and X% in bonds, instead of just choosing one bond fund, you can diversify it between those 4 bond funds. We'll get back to the blended classification in a minute. And then you have your stock investments, also known as equity investments, towards the right-hand side of that chart. There's all different types of equity investments. The green section shows you the ones based in the U.S. There's large cap investments, which tend to be a little more conservative stock-wise than the small cap stock investments. You have 2 international options to choose from. So international has a little more risk because you have to worry about not only how the companies in that mutual fund are doing, but also how the political and economic market in those other countries are doing. And then you have one specialty or sector fund. The Vanguard REIT Index only invests in real estate investment trusts. So there's a little more risk in that investment of how those real estate market is doing. So if you are one of those investors of, I can do it, I feel comfortable picking and choosing my funds, these are the funds in your account that you can pick and choose from and set up that asset allocation and monitor going forward. If you are more one of those investors of, I know I need to save for retirement, but I just don't have the time or interest, somebody else will take care of this for me, the next 2 slides might be relevant for you. These are the Vanguard Target Retirement Funds. So with the Vanguard Retirement Funds, I'm going to jump back to this slide in a minute. With the Vanguard Retirement Funds, the only thing you need to know is when do you plan to retire. You can see the different dates on the right-hand side. So if you're going to retire in the next year or 2, maybe you want to do the 2020 fund. If you're 30 years old, maybe you want to do the 2050 fund because you probably won't be retiring until around that time frame. If you're not sure of when you're going to retire yet, you can certainly look at the date of birth guidelines and choose the one closest to when you were born and invest in the corresponding target retirement fund. So with these target retirement funds, what happens is when people invest in one of them, let's say choose the 2050 fund. When people invest in the 2050 fund, Vanguard assumes that they're all around the age of 30, that they're all planning to retire somewhere around that age or that year 2050. So Vanguard is going to manage that account pretty aggressively. They have a significant amount of time until retirement. So they're going to fall in that young classification. Red and yellow here are your stock investments. So the 2050 fund probably has about 90% in stock investments right now. As it gets closer to retirement, Vanguard starts to sell down the stock amount and add more bond investments. So it usually hits its first transition around the age of 40. It drops from that 90% stock to 86, 87, 88% stock. and does some bonds, and then it keeps dropping from there. You can see the blue bars getting a little bit bigger. When you hit retirement in the retirement fund that matches your date, it's around a 60 to 65% stock and the remainder percent in bond. And then it continues that path until you hit your early 70s. Once you hit around age 72 for those investments, Vanguard plateaus it. They leave 30% in stock, the remainder in bonds, because they feel at this point people are starting to spend their retirement money. We want a little bit of stock to help it grow, but let's keep it in bonds so it's a little bit safer while they're taking distributions. So if you like that strategy, you can let Vanguard manage that account on your own. If you want to pick and choose, you have those different options to diversify from. With the Vanguard Target Retirement Funds, you can just pick one of these based upon your proximity to retirement and invest in it. It's fully diversified. There's probably about 5,000 different stock and bond investments in each one of these. So you often hear of diversifying your account, even I mentioned it earlier, and not to put all of your eggs in one basket. Rest assured that those Vanguard retirement funds are diversified for you. You can access your account at any point in time. Our website is www.bpas.com, and we have a toll-free number, 866-401-5272. Customer service reps can help you with your account. They're available Mondays through Fridays from 8 a.m. until 8 p.m. You can also call that same number at any point in time and go through the automated system, either to enroll in the plan or check your balance or even make changes on your account. So we'll walk through the website in a couple of minutes. One of the first things I included in the chat today was a link to this slide, or to this web screen here, the Employee Benefit Network. This is our online enrollment booklet. So you can access this at any point in time. It includes information about the investment options and including their performance, plan highlights like we went through, and then the summary plan description is a more detailed version of all of that information. I'm going to walk through the how-tos of how to enroll and how to designate your beneficiaries, but if you forget, the instructions are listed there. And any disclosures or notices that we provide regarding the retirement account will be listed here on a general basis. So, for example, once a year we'll provide any updates about the automatic enrollment feature and all of that. It'll always be available on this website. So feel free to grab that, bookmark it, email it to yourself so you know where to access it in the future if needed. And we'll go back here to the presentation. So the enrollment process is all online. It's 3 steps. You choose how much you want to save, how you want to invest it, and then you add your beneficiaries and you're good to go. And as we mentioned, if you're ready to get started in the plan, June 23rd is the deadline to enroll to get your contributions started by July 1. And if you miss that, it might take a couple more pays to get you started. So I highly encourage you, get in there by June 23rd. You can always make changes to your contribution amount, to your investments afterwards if you want to think things over even more. Our website is bpas.com. From the drop-down, you select participant account and then retirement account. We are in the process of updating the look of our website, so don't be surprised if you log in next week and it looks a little bit different on this screen, but it would still be the same kind of process. You'd be a participant and accessing your retirement account. After selecting participant retirement account, it brings you to this screen, and this is your login screen. You might want to bookmark this on your website for future reference. You log in over on the left-hand side. The Participant Education Center has a ton of information out there. So I mentioned a little bit, there's calculators to show if a Roth IRA, a Roth 401k or a traditional 401k would work better for you. They can be found in the purple section under Planning Calculators. If you want to pick and choose your own investments and just want a little bit of guidance, there's a risk tolerance quiz also in that purple section. If you're thinking, my goodness, she's talking about stocks and bonds and mutual funds, and I don't really know much of that kind of stuff already, the red section, Learn by Topic, has different videos and articles that can get you started on the basics of retirement planning as well. So anyhow, you log in over here on the left-hand side where it says log into your account. The first time you log in, your user ID is your social security number, just the digits, no spaces or dashes or anything. And your initial password is your date of birth, 2-digit month, 2-digit day, 4-digit year format. Include that information, select login. It's going to ask you to update your user ID and your password and to create a challenge question. So if you forgot your password going forward but can answer your challenge question successfully, it'll allow you to access your account. So choose a question that only you would know the answer to. Once you make those updates, it'll put you on this screen here. Most of the time, once you hit login, since you just did all those updates, it'll take you directly into the online enrollment process and into your account. Every once in a while, it might ask you to re-put in your user ID and password, and they would be the new ones you selected, not the date of birth and social security one. So once you get through the whole enrollment or login process, the online enrollment application starts. So you can see it's 4 steps, pretty much those 3 we talked about earlier, and then confirming your enrollment. So it'll walk you through. It's fairly easy. Select Enroll Now. First step is deciding how much you want to save, so that you can choose from the drop-down of the deferral amount if you want to do pre-tax or Roth or a combination of both. You also have the capability to increase your contributions. So let's say you're thinking, well, I can afford 5% now, but I know I need to do more in the future. You start your deferral at 5%. Do the annual increase of 1. It'll increase once a year until you hit your targeted deferral rate, which you'd put in that 10% or 15% or whatever you'd like. So if you know you're not going to be logging in too often and you just want that automated system, it's a nice, easy way to have it slowly step up your contributions. Maybe once a year you receive a raise or you pay off some credit card bills or whatever. You see that tiny increase come out of your paycheck. It shouldn't be too much, but it really can help your account grow. So choose your deferral percent, select Next. It'll give you all the different investment options for the account. Choose which ones you want. As long as the total is 100%, the Next button will light up on the bottom so you can proceed to the next step. And then the final step is designating your beneficiaries. First, you state if you're married or not, and then it gives you 1 block for a primary beneficiary. If you have additional beneficiaries, you can go ahead and add them. There's a blue box down below that says Add Primary. You can also add secondary beneficiaries. You can add as many beneficiaries as you'd like, either primary or secondary or a combination of both. Just designate the percent of proceeds to them accordingly. And you can update your beneficiaries in the future as well, straight from the website. So your final step of the enrollment process is just verifying that everything looks accurate. It'll pull in all the different information from the screens, how much you saved, where you're choosing to invest it, and who your beneficiaries are. If anything doesn't seem accurate, you can scroll back to that step and update it accordingly. If it all looks good, select Enroll Me, and you can go right on in. You'll enroll, and it'll bring you to your home page. So going forward, after you've enrolled in your plan, this is what your bpas.com website page would look like. Over on the left, you see a total account balance and a vested balance. These 2 numbers here are identical. So this person has those 3 years of service with PeopleShare. If your total vested balance was less, it means that the employer made a contribution and you haven't yet had 3 years of service. Over on the bottom right, you can see deferral change. So if you started with a percentage that now is comfortable, let's use that 5% as an example. Let's say you did 5% and you're like, well, that was easier than I thought. I want to increase it. You can go to deferral change in the future, increase it. It would take a pay or two for it to kick in. Or on the flip side of that, you started at 5%, you get that first pay, and you're like, oh, that's way more than I had hoped it would be or thought it would be. I need to adjust this. You can go into that deferral change, bring it to an amount you're comfortable with, and again, it would take a pay or two for it to take effect. So with that, that's the end of the presentation. I'm going to open the lines in a minute for questions. If there's any questions now, we'll keep them on the recording. Let's see what time it is. So in about 2 minutes, I'll take it off the recording if you want to ask questions off the side. And remember, if you're interested in enrolling, you need to complete the online enrollment process by Friday, June 23rd. Okay, we did receive a question here. Can you change your beneficiary at any time, or does it only have to be during your open enrollment? It can be at any point in time. So if you're single now and you're enrolling, but you know you're getting married in September, you can go back in September and add your spouse. Or a new child comes along, you can go in and add them. There's no restrictions of the time frame for that. It's just important to keep it up to date. All right, so I'm going to stop the recording. I will stay on the line for about 15 minutes, so if you have any questions after